Good afternoon, everyone, and welcome to our Halftime Market Insights webinar. Our goal is consistent with past webinars. We'd like to share some thoughts and comments around what happened over the first half of the year, as well as what we're watching for the second half of the year. Before we jump in, the usual housekeeping items. We are here to improve your knowledge and outlook for markets. So if you have questions, please submit them via the Q&A feature. This webinar, consistent with past webinars, will be recorded and uploaded to our YouTube channel. So if you are so moved to rewatch or share with colleagues, we encourage you to do so. For anyone who's joined this webinar series before, you know me. My name is Greg Leonberger. I'm the Director of Research here at Marquette. I will cover the U.S. economy, as well as host the webinar. Joining me today, you should be familiar names and faces. Frank Valley and James Torgerson will cover fixed income. Fred Wang and David Hernandez will cover U.S. equities and non-U.S. equities, respectively. For the alternatives portion of this afternoon's webinar, Evan Fraser will review hedge funds. Dennis Yu covers real assets, which consists of real estate and infrastructure. Amy Miller will review private equity, and Haley McCollum will review private credit. We like to start with the U.S. economy before jumping into any economic comments. Just a snapshot of what markets did over the first half of the year. The news here is overwhelmingly strong and good. We saw great market returns in 23, 24, 25, and through the first half of 26. A couple of things to note. We have seen value outperform growth during the first half of the year, and Fred will share some insight and comments about whether or not that trend will continue. For the second half of the year, and emerging markets continues to lead. Emerging markets led all of the equity markets in 2025 and is off to the strongest start in 2026. But of course, with return comes risk. In particular, we're watching concentration risk in EM indices, and David Hernandez will cover that in greater detail in his section. Fixed income is positive. Again, we look to fixed income to provide liquidity, diversification, and income. It's doing all of those so far. Yields have been higher this year. That has limited a little bit of the price appreciation story, but fixed income is also doing its part in portfolios. As we look at the economy, and we could probably spend a whole hour just talking about economic variables or outlook across economic growth. The good news is for the first quarter, that growth surprised to the upside, coming in at 2.1%, which was higher than the 1.6 expected figure. As usual, consumption drove the majority of growth, but we've also seen a lot of business investment, particularly around the AI theme. That has helped buoy growth in the first quarter of 2026. We're always watching a lot of variables and economic metrics, but one which is not particularly original but remains in the news quite a bit is inflation. The May CPI print, now as a reminder that the headline CPI includes both food and energy, came in at 4.2%. Once you carve out those volatile sectors of food and energy, core CPI was more controlled at 2.9%. June CPI came in better. The headline number was 3.5%. However, this is a number that we will continue to monitor, particularly because the inflation outlook and the inflation reading, along with the labor market, really informs Fed policy. And we started the year expecting the Fed to cut 1 to 2 times, and now we're looking at the Fed raising 1 to 2 times. And a lot of that decision is driven by economic policy. By economic numbers, but particularly around inflation, what direction that's heading. So seeing what inflation is doing will be insightful into what the Fed ultimately ends up doing. And of course, the direction of interest rates has impacts on fixed income and equity markets. So we step back and look at some of the bigger picture variables here: Fed funds rate, change in real GDP, unemployment rate, and inflation. As mentioned, if the Fed does increase one or 2 times this year, you'll see a little bit of uptick what the Fed funds rate does. Real GDP is going to hover around that 2% number. Again, that's not an overwhelmingly positive number, but it is positive. It has been pretty steady over the last couple of years, so we'll take that. Unemployment is not expected to move too much, and inflation is likely to be a bit elevated in 2026. And again, watching that dynamic between inflation and the Fed funds rate will be helpful for investors as the rest of the year plays out. But that's a quick snapshot on what markets have done the first half of the year, as well as an outlook at a very high level across the economy. And let's get into the different markets now. We'll start with the fixed income, and Frank, you can lead it off, and James, you can take us home.
Thanks, Greg. So fixed income performance in the second quarter for fixed income was good. The Bloomberg Ag was up 70 basis points. The high yield index was up 2.5%, and emerging market debt was up 4.6%. This pushed fixed income returns positive year to date. Income continues to be a main driver of returns within fixed income. During the second quarter, yields were under a little bit of pressure, particularly in the belly, which detracted from performance. However, corporate spreads tightened from 89 to 74 basis points, which provided a little bit of a tailwind. The Treasury curve has moved quite a bit year to date. Coming into 2026, the market had been pricing 2 cuts into the market. Now the market is pricing 2 hikes. This has pushed the yield on the 2-year 40 basis points higher during the quarter. The 5-year moved 28 basis points higher during the quarter. The effective funds rate may not be exactly what it appears to be. So the Fed first started cutting rates in the 2024 and 25. This lowered the Fed fund rate to 3.5%. However, actual financial conditions may be tighter than what Fed funds would indicate, as published by the San Francisco Federal Reserve Bank. This higher level of tightness within the economy could help slow it and fight inflation. Yields. Overall fixed income yields remain strong. Most starting yields remain above historical averages due to elevated treasury rates. The one outlier is going to be a high yield. High yield is below historical averages because it has abnormally tight credit spreads. So starting yields have a strong correlation to forward returns, particularly over the longer term. Currently, the AG has a starting yield of 4.7%. If nothing changes over the next year, that would be the expected return. However, if rates were to fall or spreads tighten, you could see returns in the high single digits or low double digits. It is very unlikely in today's environment to see negative total returns. In order to see a negative total return, you need to see a combination of spread and rate hikes of 100 basis points or more. I'll now turn it over to James to talk a little bit about the spread markets.
Thanks, Frank. So if you've been a regular attendee on this webinar, you've probably noticed we can be a bit repetitive in this fixed income section. Bonds are back, yields are high, and spreads are tight. If nothing else, we're at least consistent here. So all spread sectors are below their long-term averages, with loans as being the only sector trading close to its average, given some of the credit challenges and dispersion we've seen in the CCC bucket and the software sector within that market. So while we don't have it in this presentation, but looking at spreads versus their 10-year averages, maybe a bit more informative view of spread valuations relative to a longer-term time frame. So in previous Fed hiking cycles and periods of higher interest rates, spreads have materially widened following the commencement of the hiking cycle. Sometimes are an exogenous shock doing that, but for the most part, when the Fed hikes, spreads eventually widen. This dynamic has yet to really play out in this cycle, because outside of brief spurts of widening, such as Liberation Day, there has not been a significant sustained period of wider spreads. Well, this is something to monitor, particularly if rate hikes do surprise to the upside. We don't really foresee spreads widening meaningfully, given where company balance sheets sit, where fundamentals are, and the overall resilience of the U.S. economy. So AI and the hyperscalers, so your Google, Amazon, NVIDIA, people on the equity side will talk about this later in the presentation here, but they've really dominated the headlines and they've dominated the corporate bond issuance in 2026. There's been a massive increase of AI and hyperscale issuance so far in 2026, and this is expected to continue to the end of the year. While the market has been able to absorb these IG corporate bond issuances so far, if this continues, a supply overhang could loom if the market begins to turn or sentiment changes on the AI narrative. So if it does continue at these levels, there's a possibility that investors cannot or just choose not to absorb it, which could create upward pressure on credit spreads. We've talked about this sector before in the past on this webinar, but securitized credit yields are attractive. So while yields look good across fixed income, as we've mentioned many, many times, securitized credit does continue to offer yield pickup relative to corporates. In addition to this spread and yield pickup, securitized credit also provides diversification from corporate credit risk and is not nearly as exposed to the AI and the hyperscaler exposure and issuance. So as we move forward in the second half of 2026, we expect this trend of yield premium to continue and an area that investors should definitely take a look at. And then defaults. So for the first time in nearly 4 years, high yield defaults have outpaced leveraged loan defaults. This continues the recent trend we've seen over the past couple of quarters of high yield defaults increasing while they're decreasing in leveraged loans. Still both below averages, but this is not purely a reflection of the fundamentals in high yield. Quality remains high in this market, but the default spike seen in June was largely a result of the default of Dish. That was one of the largest defaults in the high yield market's history. So that really caused that spike in June of high yield defaults, and that's why they're higher than leveraged loans right now. But overall, defaults remain below averages across the board. Quality in the markets is high, maybe outside of some of the riskier triple C's and softer exposure in the loan market. But overall, defaults do bear monitoring. Fundamentals are strong, and default projections have not really materially increased for either high yield or loans. Then just finishing up here with opportunities and risks, these stay pretty similar in fixed income. As I said, we like to be consistent here. Your income generation, securitized credit, which I just touched on, you're getting a yield pickup and diversification benefit there. And then dispersion in credit markets. As I've mentioned a couple of times here, you're starting to see a bit more dispersion within the below investment grade credit markets and high yield and loans. As triple C, lower quality loans continue to face credit stress, you're going to start to see more and more dispersion and bifurcation, and that is a good opportunity for active management. And then risks, Frank mentioned it, talking about the proxy Fed funds rate, restrictive financial conditions. The financial conditions we actually experience as consumers in the economy may be more restrictive than what the Fed funds rate shows alone. Just touched on it, but the concentration of the issuance and hyperscalers within the AI related trade, definitely something that bears monitoring. And then as always, wild cards. These consist of a lot of things, and we say them every time, but they always come to fruition when you least expect it, as we definitely saw in Q1 and could probably see again here moving forward. Back to you, Greg.
Thanks, James. And just to reiterate a point that you opened up with, the story in fixed income remains consistent. Absolute yield levels are high, which is good for portfolios. Spreads are tight, which means two things. Number one, there's not a lot of value in fixed income today, but also perceived risk is low across the market. Let's move now to equities. And Fred, it's been a little bit of a changing story and changing leadership in the market here. So curious to hear your thoughts on what happened during the first half of the year and what you're watching for on the second half of the year.
Great. So starting with performance, following a turbulent Q1, the second quarter of 2026 can be best characterized as a sharp rebound off the March lows. The quarter was defined by strong momentum in technology and AI themes, strong earnings, expanding margins, and an easing of the US-Iran conflict. An early rally in April was led by mega cap growth and hyperscalers, but by quarter end, the market had broadened out with small cap, micro cap, equal weight, and value benchmarks all hitting new record highs. The S&P 500 had its best quarter since 2020, going up 15.2%, and small caps performed even better, with the Russell 2000 up 21.5% for the quarter. The AI trade has continued to trickle down to small caps, with smaller suppliers and semiconductors seen as beneficiaries. Within the S&P 500, 9 out of 11 sectors finished the quarter higher, with technology and industrials leading, while utilities and energy lagged. Semiconductors were the standout, contributing to almost half of the returns for the S&P for the quarter. Energy underperformed as oil prices fell back to pre-Iran conflict levels. During the quarter, there was a change in investor sentiment as capital shifted away from AI hyperscalers into infrastructure companies supplying the build-out. Looking at valuations, large caps currently trade at a notable premium to their smaller peers. The S&P 500 recently sat near 27 times PE versus roughly 24 times for the Russell 2000. Currently, mid and small caps are trading cheaper than large caps on forward earnings, and given that small cap earnings estimates have also been revised higher at a faster rate than large caps, the valuation gap between small and large cap companies are expected to close in the near future. Looking at the decomposition of returns, the S&P 500 has become increasingly driven by earnings growth over the past few years. What started as market speculation and AI enthusiasm in 2023 has slowly converted to fundamental earnings growth. I think this is important to highlight because not all bubbles pop. These past few years shows a gradual deflation of valuation multiples as investors focus on earnings and ROI. The combination of multiple compression alongside earnings growth means index level price appreciation this year has been driven almost entirely by fundamentals rather than re-rating. So it wouldn't be an interesting update if I didn't talk about SpaceX and the other upcoming IPOs. SpaceX IPO'd at $135 a share on June 12th, raising roughly $75 billion at a $1.77 trillion valuation. And it surged 19% on its debut before jumping another 20% the next trading day. Shares have since given back all of that and more, falling from post-IPO high of $225 per share to around $112 as of today. Anthropic and OpenAI have not yet gone public, but both have confidentially filed for IPOs in June, but neither has set a firm listing date. OpenAI is now reportedly leaning toward pushing its debut back into 2027 rather than late 2026, in part because of SpaceX's volatile performance, which has dented confidence in megacap tech listings. While Anthropic is still said to be tracking towards a late 2026 debut. Within the Russell 1000, you can see that even with a $2.2 trillion valuation at the end of June, SpaceX makes up less than 1% of the index. That's because almost all major indices are float adjusted, and the IPO only released 3% of the total shares of the company. So depending on the amount of shares released, the outcome of Anthropic and OpenAI going public later this year could have a similar impact on markets and indices. Moving on, as of June 30th, the Mag 7 are trailing the cap-weighted S&P 500 by around 13%. It's a sharp reversal from the group's dominance in 2023 and 2024. Trading in these names has become less as a single AI trade and more on individual company performance. The underperformance masks wide dispersion rather than uniform weakness. Microsoft is down 23% year to date on concerns about a $190 billion AI infrastructure spending plan, and Meta is also down 15% for the year. At the same time, Alphabet posted double-digit gains. Only 3 Mag 7 names remain among the S&P 500's top contributors to returns this year, down from 7 for 2024, which is consistent with the broadening market leadership. Through the first half of 2026, the Magnificent Seven roughly broke even, while chip stocks staged one of their greatest runs in decades. The Philadelphia Semiconductor Index rose about 160% over a one-year period, on pace for its best year since 1999. This shows that capital is rotating from the platforms bearing all the AI capex bills towards the enablers building the underlying compute, memory, and equipment. So June this year was Russell's first year moving into a semi-annual reconstitution schedule, with a smaller December rebalance to follow. Roughly 62 companies were added to the Russell 1000, with 43 graduating from the Russell 2000. Technology and industrials each contributed 18 new constituents. Style indices shifted too. Chip makers, including Micron and AMD, moved from the Russell 1000 value into the growth index. The biggest change was in large and mid-cap growth indices, where semiconductors are now 30% of the Russell 1000 growth and almost 10% of the Russell mid-cap growth. This could ultimately be a challenge for active managers in this space, as their performance in the future will likely depend on their relative position to IT and semiconductors. Both large and small cap earnings growth estimates for 2026 have been revised upward over the course of the year, but the magnitude has been far larger for small caps. Russell 2000 full year 2026 earnings growth expectations rose from roughly 20% at the end of last year to about 39% by the end of Q2. S&P 500 earnings growth projections moved from roughly 13% in earlier year forecasts to as high as 28% by the end of the second quarter. The net effect is that both large and small caps now carry meaningfully higher growth expectations than at the start of the year. But small caps upward revision has been steeper, which explains Russell 2000's outperformance compared to the S&P and Russell 1000. And finally, looking at opportunities and risks. On the opportunity side, AI CapEx spending is projected to be at least $600 billion this year. The infrastructure companies supplying that build out, the semiconductors, the memory, and the storage companies have already captured an outsized share of market returns. And it's a trend that could continue if AI demand holds. Market leadership is also continuing to broaden as it continues to shift from a narrow AI hyperscaler-driven rally to one where market gain is spread across a much larger portion of the market, with small cap, micro cap, equal weight, and value benchmarks all reaching new record highs alongside the mega cap names. S&P 500 earnings projections for this year have already been revised higher from the same time last year. As new data is reported, earnings estimates can potentially be revised even higher throughout the year, which would produce additional upside despite an already strong year-to-date performance. Looking at the risks within broad market indices, an increasingly large share of earnings growth in CapEx is tied to AI and related infrastructure. If future earnings fails to show that spending translating into real economic returns, the names driving the current rally, the semiconductors, the hyperscalers, are vulnerable to a sharp re-rating. At the same time, May inflation data showed CPI at an annual rate of 4.2%. That's the highest reading in 3 years. Should this trend continue, rising prices can potentially pressure the Fed to pivot towards a more hawkish rate policy, which can lead to rate hikes. And finally, the U.S.-Iran conflict remains unresolved. Further escalation or new geopolitical shocks remain a key risk to global economic stability. And then at the same time, the outcome of the upcoming midterm elections in November could also adversely impact economic policy going forward.
Thanks, Fred. And again, some of the themes here are similar to what we've shared in past webinars, certainly being aware of that AI concentration across indices, but also recognize that the market appears to be evolving with a broadening of market leadership. And at the end of the day, it still comes down to earnings. Companies have to deliver on earnings expectations. If that's the case, I think that's a solid foundation for further positive returns out of equity markets. If you see a reversal in actual earnings versus projected, then that's going to be a headwind for the market. Okay, let's move over to the non-U.S. side now. And David, non-U.S. led the charge last year across equity markets and off to a good start again this year, particularly in emerging markets. So what are you seeing and what are you watching for?
Yeah, very good start to the year. And this was after a difficult March, which saw double-digit losses, and that was related to the U.S.-Iran conflict. Non-U.S. equities have rebounded here in the second quarter, leading to very strong returns. There was a modest pullback in the month of June, but if you look at the full quarter, very strong quarter. And that was especially the case within emerging markets, as Greg said. Now, if we look at the MSCI EAFE index, that finished the quarter up 11%. EM, however, was up 24%. And if we look at the trailing one-year return, emerging market equities are now up north of 40%. So while the U.S.-Iran conflict did create significant volatility late in the first quarter, non-U.S. equities recovered quickly, and emerging markets have established themselves as the leaders in 2026. Now, in some later slides, I'll discuss the factors that have driven EM higher, and I'm also going to review the concentration concerns that we have in that asset class. So first, on concentration, when we break out the performance by sector, the rebound was not evenly distributed. Information technology was by far the strongest contributor in the second quarter, up roughly 64%. And that strength really was a key driver of non-U.S. equity returns this year. There were some sectors that also had positive performance. You have financials and industrials, though not nearly as positive on the IT side. We did see energy lag after oil prices came down here in the second quarter. Now, that concentration and that AI technology story on the sector side also shows up very clearly when looking at it on the country level. Korea and Taiwan have been the biggest drivers of non-U.S. equity performance year to date, largely because of their exposure to semiconductors and technology companies. Korea, through June 30th, was up more than 100% year to date, and Taiwan was up more than 60%. In contrast, other EM countries, China's continued to lag, and India has been weaker this year. So the key takeaway in non-U.S. equities is that non-U.S. equities returns have been strong, but they've been highly concentrated in a few technology-heavy markets. And that brings us to what we think is one of the more important themes in non-U.S. equities, and that's EM concentration. Emerging markets have been huge beneficiaries of the AI infrastructure build-out, but that has made the index much more dependent on a small number of companies. 3 stocks now account for nearly 1/3 of the EM index, and those companies also represent a very large weight within each respective home country index. Now, in comparison, looking at EM to US and non-US developed, the MSCI US index, the top 3 stocks constitute 18% of that index, and the top 3 stocks constitute 7% of the MSCI EAFE index. So much larger concentration happening within emerging markets. And this is really historically high levels of concentration. And when you look at the top two stocks, TSMC and Samsung, those two stocks alone now make up a larger share of the MSCI EM index than the largest 10 stocks from 2016, so back over 10 years ago. Now, this isn't necessarily a negative in the near term because these companies have been generating strong earnings and they've been major beneficiaries of the AI cycle, but it does change the risk profile of emerging markets. In the past, investors looked at EM as a way to get broad diversification across countries, sectors, across themes. And today, there's a much larger portion of the return stream that it's tied to a narrow set of AI-related companies. Now, in comparison, developed international markets remain less concentrated, and this may make them a better, perhaps, diversifier in client portfolios at this point today. Now, concentration is not limited to benchmark weights, but it's also present in performance. So of the 1,200 plus stocks that are in the EM index, only 18% of them are beating the benchmark's 24% year-to-date return. And that's the lowest percentage of outperformance we've seen in 10 plus years. To further illustrate the concentration and performance, the EM's index's top 10 contributors are all technology companies, and their average return year-to-date is 250%. Turning to valuations, multiples remain elevated across equities, but I do think there's some interesting positive numbers on this page. If you look at the EAFE small cap and EM index, you look at the trailing PE ratio, those ratios are expensive relative to history. But if you look at the forward-looking price to earnings ratio, it's actually cheap compared to history. Now, the forward PE takes today's price, or the price as of June 30th, and then compares it to the future 12-month earnings growth. And that is why that number is lower. Because the good news is that earnings expectations have improved meaningfully so far in 2026. Now, at the start of the year, consensus already called for double-digit earnings growth across EAFE, EAFE small cap, and emerging markets. But by mid-year 2026, those estimates have been revised higher, and they've been revised higher, especially within the emerging markets. And this is important because if you remember back in 2025, returns were driven by multiple expansion and currency. This year, earnings is playing a bigger role, which is creating a healthier backdrop. And this also explains why markets were able to look through that first quarter volatility and recover so quickly here in the second quarter. Now, I've spent a lot of my slide real estate on emerging markets, but I do have one dedicated slide for developed markets. Now, I talked about the oil price backdrop improving in the second quarter. There's certainly, as Fred mentioned, some uncertainty with the U.S.-Iran ceasefire, so we'll see how that develops for the rest of the year. In the first quarter, the closure of that strait was a major concern because it pushed oil prices higher, and that raised questions around inflation, around the potential for interest rates, and the possible contraction of economic growth. In the second quarter, the reopening of the strait helped bring oil prices back down, and we did see European equities rebound as that pressure eased. Europe, as a region, is more sensitive to energy costs, so the ongoing U.S.-Iran conflict serves as a key risk for the global economy, but I think especially for that region. For opportunities and risk within non-U.S. equities, I've talked about the earnings growth and them driving returns here in 2026, and that's been especially the case within emerging markets. That connects with the outlook for Asia technology stocks with that positive earning growth and the potential momentum to carry forward from here. Countries that have energy independence might have some additional opportunities, as well as countries that are energy producers, depending on what happens with this conflict. The uncertainty of war is a key risk. If you look at the risks that we have here, they're essentially the same risk as what Fred went through on the U.S. equity side, concerns for higher inflation and thus higher interest rates. And then concentration is a concern from emerging markets. We are likely to see some volatility depending on whether that AI trade persists. If it persists, the emerging markets should do well. But if we get a pullback within that theme, that may be a challenge for emerging markets given the concentration.
That's a good final reminder too. I know you spent a couple slides on it talking about the concentration within emerging markets, but that's certainly that has become a significant thing to watch over the course of the second half of the year. And also not forgetting about developed markets, how that can be a diversifier to some of those concentration issues. At the end of the day, just like US equities, it does come down to earnings, and keep an eye on what those earnings reports look like versus expectations. All right, well, that's traditional markets, a fixed income, US equity, non-US equity. Let's transition now to alternatives, and Evan's going to lead us through hedge funds. Evan, all yours.
Yeah, thank you, Greg. I would say that hedge funds are continuing to chug along here in 2026. March was somewhat difficult for the asset class, but things recovered quite nicely during the second quarter. As you can see here, pretty much every major hedge fund index finished the second quarter with solid positive returns, and all are positive on a year-to-date basis. During 2Q, I would say equity hedge was the standout performer with a return of over 10%. Strategies like event-driven and put-right also posted solid gains for the quarter. Macro strategies were a little more mixed, I would say, up around 1.5% in 2Q, but certainly trailing the broader hedge fund universe. As you can see, you had obviously some shifting risk sentiment over the last couple of months, and when you have kind of whipsawing markets, that can sometimes work against macro strategies. But overall, again, solid performance from the asset class. And one thing worth highlighting before we move on is that the returns you're seeing here, on a quarter and year-to-date basis, have been generated with significantly less volatility than sort of broad equity markets have experienced during the year. That's one of the value propositions of the asset class, right? Sort of participation in rising markets while also kind of providing downside protection during periods of stress. So the first half of the year, I would say, kind of reinforced those diversification benefits of hedge funds that we've discussed in great detail on webinars past. So we've shown this chart before. It compares the top 50 crowded long positions with the top 50 crowded short positions across hedge funds. It compares, in this case, year-to-date performance. And we also have the S&P 500 on here as well in green. And what's striking here is sort of the magnitude of the performance spread in the second quarter between the top longs in purple and the top shorts in blue, as well as the S&P 500. And that spread was about 30 percentage points in 2Q alone. So this tells us kind of two things. So first, stock selection mattered far more than just having market beta in 2Q. And second, that dispersion across individual companies is elevated. And that creates an attractive opportunity and environment for hedge fund managers. One caveat to mention, and I believe we have this on the risks and opportunities slide, is that crowded positioning, crowded trades can become a risk. So if we see market sentiment shifting, these more popular positions could unwind relatively quickly. So while the current environment has rewarded active stock picking, it also underscores the importance of risk management and the avoidance of excessive concentration within these top names. So we like to look at the options market for potential signals, and this I thought was a pretty interesting one. So this chart compares the implied volatility of the NASDAQ, which of course is more tech heavy, with that of the broader S&P 500. And implied volatility basically reflects the market's expectation of future price movements. And it's a good proxy for how much investors are willing to pay for downside protection. And as you can see here, the ratio between, again, the implied volatility of the NASDAQ and implied vol of the S&P 500 has climbed to one of the highest levels we've seen in basically 2 decades. So in other words, investors are paying historically, they're paying a historically large amount or a premium to hedge technology stocks relative to the broad market. So, as Fred kind of talked about, the enthusiasm around artificial intelligence remains strong. There's clearly kind of growing uncertainty about which companies specifically are going to emerge as long-term AI winners. One thing I did want to point out, implied volatility, higher implied vol, doesn't necessarily signal that a broad-based or tech-focused correction is imminent, but it does suggest that investors expect more dispersion across the tech sector going forward. And I think that could actually potentially be a constructive backdrop for hedge funds. Like I said earlier, more dispersion creates more opportunities for managers to generate alpha, both on the long and short side of their books. So this is another interesting one. An area that we're watching pretty closely is fund positioning in the Japanese yen. Currently investors have built one of the largest net short yen positions that we've seen in decades. And this reflects the popularity of the yen carry trade, which Greg, I know you detailed in your quarterly letter, where investors are basically borrowing in the lower yielding yen and investing in higher yielding assets, including U.S. equities, credit, et cetera. And you can see here, again, you can't see here because it doesn't go back far enough, but the yen trades at close to a 40-year low relative to the U.S. dollar. So this carry trade has been an important source of liquidity in terms of supporting risk assets. But it does also create a potential source of risk and market volatility. So you'll recall potentially 2 years ago, the Bank of Japan unexpectedly raised its policy rate. That led to some turmoil in international and U.S. equity markets, because if the funding currency in a carry trade strengthens, that forces the levered investors to buy back the currency and then sell the risk assets to close out their positions. So, if the Bank of Japan decides to make a similar move, or if global risk sentiment deteriorates, the yen could strengthen from where it is now, and that could lead to a similar type of unwind. Again, we're not necessarily forecasting that. Given the magnitude of the yen positioning as well as where the currency trades today, though, it is reasonable to say that this is an important risk factor to monitor in the coming quarters and beyond. So one final slide before we get to the risk and ops. And again, I thought this was very interesting as well, potential opportunity within credit markets for credit-focused hedge funds. Basically, this chart is comparing how the credit rating agencies are evaluating leveraged loans in the software space relative to how the market is actually pricing those same loans. And what we see here is that many loans carrying identical credit ratings trade at meaningfully different spreads, right? So in other words, the market is differentiating credit quality much more aggressively than the rating agencies are, and is seeing more dispersion in software loans specifically than the rating agencies currently reflect. James has talked about this in the past, but much of this divergence kind of emerged following the software sell-off that we saw earlier this year, as investors became more and more selective over which companies are, again, best positioned to benefit or be disrupted by AI, leading them to price sort of company-specific risks more aggressively, potentially, than the ratings agency. So all of this is to say that it creates a potentially attractive opportunity set for those credit-focused managers, particularly those with experience in leveraged loans and stress credits. So kind of to wrap things up at a high level, we continue to view this as a constructive environment for hedge funds broadly, but it's also one that requires kind of careful manager diligence and selection. So really quickly on the opportunity side, I talked about higher dispersion across both equities and credits. That's creating good opportunities for managers. Higher interest rates. Frank talked about kind of changing interest rate expectations coming into the year, maybe a couple cuts now, a little less so. Those higher rates tend to support a variety of different hedge fund strategies. So relative value, for instance, volatility risk premium, even equity long short. A lot of those have performance profiles that are highly dependent and a function of base rates. So that's the opportunities. Really quickly on the risks, a couple of them, they've been detailed earlier today, right? So geopolitical strife, crowded positioning that I talked about earlier, and then that potential unwind of the yen carry trade could amplify volatility if market sentiment shifts. But again, overall, we feel like hedge funds remain well positioned as portfolio diversifiers that have the potential to benefit from higher dispersion within all different types of assets. So I think that's it for hedge funds. I will turn it back over to you, Greg.
Thanks, Evan. Yeah, and the story of hedge funds has really been a good one the last couple of years of executing upon expectations in terms of capital preservation, also participating in market upside. And just to reiterate a couple of the risk factors that you mentioned here that we haven't really talked about a lot on past webinars, but I think could be insightful to the direction of markets for the remainder of the year is the implied Nasdaq volatility, right, and the trend there, as well as what's going on with the direction of the yen and the yen carry trade. Again, the base case isn't to see an erosion of equity markets or an erosion of the yen trade, which could roil markets. But again, helpful things to keep an eye on as we watch what transpires in the broader markets for the second half of 2026. Let's go on to real assets now. And Dennis has both real estate and infrastructure to cover. So Dennis, I'll hand it to you.
All right. I'll start off with real estate. As a reminder, private real estate infrastructure performance are reported on lagged basis. For the first quarter of this year, the NFI Odyssey Index achieved a total gross return of 1.3%. This was driven by 1.1% income and 0.3% appreciation. As a result, we are currently witnessing 7 quarters of consecutive positive returns. As valuations stabilize and capital returns, real estate is in the middle of performance recovery. Turning into fundamentals, net operating income growth is expected to be the primary driver of real estate returns going forward, especially in an environment where cap rate spread to interest rate is significantly narrowed. Dive deeper on income growth. Industrial stands out as the leader historically among 4 traditional sectors in real estate. However, more recent data shows that rent growth in industrial, multifamily, and retail will be comparable on a going forward basis. This office remains as the troubled sector. And now, if we broaden the comparison to include alternative sectors here, as shown in this chart, senior housing and data centers are expected to lead in near-term NOI growth projections. However, it is worth noting that over the longer term, the projected growth dispersion across sectors narrows, suggesting that the current outperformance of alternative sectors may moderate as the broader real estate market continues to recover. Switching gears to valuations, this chart highlights the meaningful divergence across sectors. As I mentioned previously, favored sectors such as healthcare continue to attract meaningful institutional capital inflow, resulting in investors paying significant valuation premiums. In contrast, sectors that have fallen out of favor are experiencing capital outflows, creating more attractive entry points as well. To summarize real estate, while pockets of distress remain across real estate, the non-core opportunities set has become more selective as the debt market has proven to be more active than expected. Therefore, forced selling have been limited, requiring managers to patiently identify opportunities. Meanwhile, sector and market selection are still very important, given all sector now leads growth outlook. On the risk side, the office sector remains challenged, and also paying premium for popular sectors leaves less margin for error and may reduce future return potential on investments. For private infrastructure, we see 2% quarterly return in the first quarter this year, with 11.5% return over 1 year and consistent performance over longer periods. This indicates a steady and reliable performance for infrastructure, making it a very attractive option for investors who prefer income generation and inflation protection. Compared to global equities and global bonds, private infrastructure has historically delivered a more consistent return across different market environments. In period of above trend inflation, it has generally outperformed, supported by inflation-linked revenues and the essential nature of its underlying assets. It is one of the key reasons why infrastructure remains as valuable long-term portfolio diversifier. Within infrastructure, return drives can be very different by sectors. For example, digital infrastructure is more capital appreciation driven, supported by a strong secular growth. Assets in transportation and utility generate a much larger shares of return through its current income. With continuing demand for digital infrastructure due to AI expansion, one of the biggest challenges here is the demand for power. Electricity demand in the U.S. expected to be more than tripled over the next 5 years. Therefore, we have a high conviction in energy-related infrastructure investment in the foreseeable future. So overall, I think infrastructure remains as a reliable inflation hedging and income-generating asset class. As power demand surges from AI development, there's a growing need for energy generation and transmission. On the real estate side, GDP-linked assets can be more volatile in a slowdown, and unlike other traditional core infrastructure sectors, data centers remain more reliant on capital appreciation, driven by leasing, development, and multiple expansion. With that, back to you, Greg.
Thanks, Dennis. And just to circle back to the real estate discussion for a quick minute, clearly the recovery is in a good spot, 7 positive quarters of returns. Office still has some work to be done, but in terms of investor expectations, most of the returns in the core space will be driven by income rather than price appreciation. As we look at infrastructure has been a steady story. It's an inflation hedge, source of income. The underlying contracts tend to be long-term, high barriers to entry. So it's been a pretty good addition for institutional portfolios over the years. So let's now transition to the last part of today's webinar, private markets. We have both private equity and private credit. Amy, you can start us off, and then Haley, you can finish it.
Great, thanks, Greg. We'll start with performance. And like real assets, performance is reported on a lagged basis and is as of the first quarter. Private markets delivered positive returns during the period and generally outperformed public equities, which declined. The U.S. and global private equity markets had modest positive returns, with venture capital outperforming both domestically and globally. Despite near-term volatility, private equity and venture capital continue to provide diversification benefits, access to high-growth companies, and attractive long-term return potential. Going to deal activity in the U.S. private equity deal activity did remain healthy during the period. Deal volume increased quarter over quarter and year over year, while total deal value declined both on a quarter-over-quarter basis and year-over-year basis. Activity shifted towards smaller transactions as investors remained selective in response to market volatility, financing costs, and economic uncertainty. For valuations, U.S. middle market buyout valuations moderated in the quarter, with median EV to EBITDA multiples declining to 11.5 times and 11.9 times for the trailing 12 quarters. Tighter lending conditions and more selective financing contributed to this decline, although valuations remain near long-term historical averages. With limited room for multiple expansion, private equity GPs are increasingly focused on operational improvements, earnings growth, and value creation initiatives to drive returns. On the exit activity front, U.S. private equity slowed in the first quarter following strong momentum in 2025. Market uncertainty related to the AI disruption, geopolitical developments, and interest rate expectations tempered transaction activity. While sponsors have more exit options than in recent years, valuation gaps between buyers and sellers remain a challenge. Despite the slowdown, the exit to investment ratio remains elevated as investors continue to seek liquidity and distributions. Switching over to U.S. venture, the deal activity reached record highs in the first quarter, driven by several AI-focused mega deals. Capital deployment was highly concentrated, with the 5 largest transactions accounting for nearly 3/4 of total deal value. While overall investment activity remained robust, investors continued to favor established companies with clear market leadership, particularly within AI, infrastructure, and other innovation-driven sectors. On valuations for venture capital, these increased across all stages in the first quarter, led by late-stage and AI-related financings. Strong investor demand for leading AI companies drove higher pre-money valuations and larger funding rounds. However, the valuation gains were concentrated among a relatively small group of companies, while investors remained selective toward businesses with weaker growth profiles or less differentiated competitive positions. For exit activity, venture capital reached its second highest value on record in the first quarter, trailing only 2021. Results were heavily influenced by SpaceX's $250 billion acquisition of xAI, which accounted for roughly 72% of total exit value, highlighting the concentration of liquidity within the market. While large exits demonstrate improving conditions, the broader IPO and M&A activity remains measured, leaving many companies waiting for more consistent liquidity opportunities. On the opportunities and risk section, key opportunities include lower middle market private equity, which offers attractive entry valuations and less competition, as well as AI and digital infrastructure investments supported by growing demand for computing power and energy. Secondaries also continue to benefit from strong liquidity demand, with key risks including still constrained exit environment, uncertainty surrounding software and technology valuations amid the AI disruption, and increasing fundraising concentration among larger, more established managers. Back to you, Greg.
Thank you, Amy. Now that's the equity side of things. How about the credit side of things, Haley?
Just like Amy and Dennis said, for private equity and real assets, private credit performance is reported on a lag, and so everything on this slide is as of the first quarter of this year. Q1 was characterized by a number of major headwinds that caused fears around performance for private credit markets. Private credit also saw some pressure because of its meaningful exposure to software. On top of that, concerns around some of the larger BDCs and redemption pressures added to the uncertainty. Despite all of this, private credit still delivered positive returns for the quarter, with middle market direct lending generating a positive 1.1% return and outperforming liquid credit markets. Over longer periods of time, private credit has continued to deliver high single-digit or low double-digit absolute returns. Consistent with prior returns, contractual income has remained steady and has been a primary driver of returns over time. You can see a slight uptick in unrealized losses shown here in purple over the most recent one-year return period. This was driven by mark-to-market write-downs, primarily related to software in the quarter, and also reflected the small sell-off seen in leveraged loans during the period. While it'll be important to see how valuations evolve over the coming quarters, it is possible that many of these unrealized losses could reverse, but this is something that we're watching very closely. One positive takeaway from some of the weaknesses that we've seen this year is that new private credit deals are coming to market with wider spreads. Over the past 3 months, spreads on new issuance have widened by about 48 basis points, and the gap between private credit and leveraged loans has also increased, which should support good returns going forward. We've also seen some positive movement towards more lender-friendly protections, and that is a positive for private credit investors. On the flip side, that we've seen private credit issuance fall substantially due to the broader market uncertainty, with less than $30 billion of new issuance from sponsor-backed deals in Q2. This is the lowest volume since 2Q of 2023. The moderation is reflective of a broader uncertainty from private equity. We continue to hope for a rebound in M&A activity, but this is also suppressed so far this year with a broader reset in lender terms. We've also seen a modest shift away from issuance in technology and software, given some of the concerns around AI disruption, with issuance shifting in favor of more resilient sectors that are insulated from AI risk. Now wrapping up with opportunities and risks in private credit, we believe that private credit represents an important allocation in portfolios. All-in yields remain attractive and income remains a nice source of stability in portfolios. Credit fundamentals have been resilient despite what the broader media headlines may say. We've also seen some positive shifts towards more attractive spreads and more lender-friendly terms, and that's great for private credit in general. Ongoing pressures remain for BDCs related to retail-oriented redemptions, but institutional investors are not pulling back from the asset class, and this continues to provide stability. On the risk side, it's an important reminder that this asset class does have credit risks, so a severe recession would impact private credit markets just like it would liquid markets. The risks around AI disruption remain a headwind for software and is also something we're watching closely, but this is not unique to private credit. That said, we believe the ongoing headlines are often misleading or slightly exaggerated, and we still believe private credit represents an attractive opportunity for investors.
And Haley, that's a great point to reiterate as we wrap up here, that the headlines were scary. There are a lot of them, but the underlying investments across these portfolios remained healthy, and private credit continues to be an important part of portfolios. Well, I just checked the Q&A section. I didn't see any questions come up, so we'll land here and wrap up for the afternoon. I want to thank everyone for joining us. We hope this has been helpful to you and your committees as you think about not only understanding what happened the first half of the year, but also what to watch for and what some of the trends are that we are going to track carefully as markets play out for the rest of the year. We'd like to thank you for joining us. If there is anything else in your mind that we didn't cover today, please reach out to any of us. We are always happy to help and answer questions. Thank you. Have a great rest of the afternoon. We will see you next time.